My guest today is Atif Mian. Atif is a professor of economics at Princeton and has become one of the foremost experts on the relationship between financial markets and the macroeconomy. He's the author of the acclaimed book House of Debt, where he argues that the gigantic increase in household debt was the primary driver of the crash of 2008.
Hello, Atif. You've been doing some of the most influential research on the Great Recession, the Great Financial Crisis, on indebtedness, and on what's going on with this current crisis. When you were writing about so it's really a pleasure to have you here. Thanks very much. When the financial crisis happened, you wrote a book called The House of Debt on what caused the Great Recession and how to prevent future recurrences. Can you tell us what is, in your view, what are the two or three main views about why the great financial crisis took place, and why, in your view, the deterioration of households' balance sheets of the debt position of households is the one that empirically makes more sense?
Yes, absolutely. Let me take a step back somewhat from the great financial crisis, and I'm doing that partly because I want to tie in the financial crisis of 2008 to the events today, which I'm sure we'll be talking about going forward. I want to start the story from the 1980s, if you will, because something very interesting started to happen from the 1980s onwards in financial markets. And the financial crisis of 2008 was very much a consequence of those forces. So that's why I'm going back a little bit in time. We know now, with hindsight at least, that something structurally shifts, certainly in the US economy, but to some extent globally as well. And that is this rise in extreme inequality. And by extreme inequality, I mean the share of income going to the top 1%, and they start accumulating not just a higher and higher share of income, but also a higher and higher share of wealth in the overall economy. Now, one natural consequence of that process, given the financial system that we have, which is primarily credit or debt-based, if you will. So when people at the very top accumulate more and more assets, they tend to disproportionately hold those assets through debt instruments, fixed income instruments. And so correspondingly, from 1980 onwards, there's another trend that starts to show up, which is, along with this rise in extreme inequality, we also start to see a rise in credit, overall credit as a share of the economy, total credit to GDP, if you will. And that also starts to boom along with the rise in inequality. And early on, that rise in credit is disproportionately concentrated in the private sector, and then within the private sector in the household sector space. And so what you see is, you see this rise in household credit to GDP, not just in the US, but in many other advanced economies of the world, for example, Spain, being a very well-known example. And all of those advanced economies, they start seeing a rise in household credit at a scale that we had not seen before, really. And so that kept building up. One important aspect which we talked about in our earlier work when we referred to the financial crisis of 2008 was that rise in household credit was not concentrated in the top 1% who are becoming richer and richer. If they are the ones getting all this, borrowing all this debt, you might say, well, they're becoming richer, so they can kind of, they have higher income, lifetime income, and they can pay for it, and there's nothing much to worry about. What was worrying in the national statistics, if you will, was that this rise in household credit was skewed towards those segments of the population that were not growing at the fastest pace in terms of their income per capita. And so the real burden of debt, if you will, was rising even faster than what aggregate statistics like credit to GDP might suggest. So this is the situation that was building up. And the other piece which is important to keep in mind is, you might ask another question, which is, well, if those who were borrowing were not seeing their incomes rise as fast as the top, why were they able to borrow? Why was the financial sector not intervening and telling them, look, stop, you can't borrow anymore? And the basic answer to that question is that they were able to borrow because interest rates kept falling. And so that's the third variable I want to keep in mind. So again, just to remind everyone, the first was rising inequality. The second one is rising credit or financialization of the economy, if you will. And the third important variable to keep in mind to understand the bigger story is the fall in the interest rate. Why is the fall in interest rate important? Well, for two reasons. The first is that for the same level of income, a lower interest rate allows you to borrow more, and that's what those people were doing. But there's a second very important consequence of lower interest rates, which is that lower interest rate raises asset prices, and in particular, housing values. And so, again, the people below the top 1% and so on, they were able to borrow because the main collateral that they had, which is housing, kept rising in value, and they were essentially borrowing against it, either directly or indirectly. This is the situation that kept building up until 2008. And then what happens on the eve of 2008, essentially 2007, is that housing market starts to collapse, starts to go down. We can get into the reasons of that, but I think those reasons are essentially not that important for the question at hand. Once that happens, this dynamic loop that was going on, which was more credit against housing, that slowed down and then reversed. This class of households could not borrow more, and that caused the recession, essentially. But why a recession? Because they cut back on their spending. So there was all of a sudden a deficiency in demand, because all of this borrowing that I was referring to was essentially financing aggregate demand in the economy from 1980s onwards. And that process kind of collapsed, which led to the recession of 2008.
Atif, many of the accounts of the Great Recession take a big care to worry about institutional details, such as in the US, the mortgage markets, which were subsidized by the state, details such as the collateralized debt obligations, the fact that the rating agencies failed, etc. Your account really, to some extent, says, man, those are details. There really is something happening much, much longer trend. And with some other details, it would have been somewhat different, but we would have seen the same build-up of debt. Is this a right interpretation?
That is absolutely correct. And one piece of evidence in favor of that argument, in my view, is that we had this crisis in Europe as well. And the institutional details in Europe are not necessarily the same as the US. For example, they don't have the GSEs in Europe, and yet we had a crisis in Europe. A more recent example of that is China. And we have seen since 2008 that it is China now that is relying a lot more on household credit for generating domestic demand. And we have to ask ourselves the question now, why is China doing that? I mean, China has seen a rise in household credit that is unprecedented, even relative to, I said 2008 was unprecedented, but relative to 2008, the Chinese growth of household credit is even more ambitious, if you will. And so I think there's a deeper question as to, that's precisely why I started from 1980. There's a deeper reason that the global economy seems to be addicted to debt. And when the US households basically said, sorry, we cannot borrow as much, and as a result, they could not run as large a deficit with China, all of a sudden, that pressure was shifted onto China. And now China had to find ways to generate demand for its output. And now China started to rely on domestic credit much more than it earlier did, because previously it was relying on external sector to absorb its excess supply or output. And so then you see this boom in credit domestically in China, which as we speak is still ongoing to a large extent. This is why I say, look, let's not get confused here by the institutional details here. There is a bigger game in town that we must bring our focus back to. That is the structural issue at play. And one way to summarize that structural issue in my mind is that our global macroeconomic system, if you will, is not in balance. It is in a state of imbalance, which is forcing the hand of the credit markets, including the government sector, because when the private credit is unable to generate credit and hence boost demand, there is again demand deficiency, and then the pressure goes on the public sector to run deficits and boost demand. But all of this, whether you talk about household credit or more recently you talk about public deficits and government debt, all of this is a reflection or a symptom of a deeper problem, of a deeper malaise, which is structural in nature, and it's really the imbalance or the inequality that I started off with.
So let's plug a little bit away at this imbalance. So there are all these people who want to save. Well, great. That's not, I mean, by traditional economics, that's not a bad thing. Then we have cheap source of investment. We can do all these beautiful things in our societies with all these cheap, low interest rates, a lot of opportunities for productive investment. Why is this basic mechanism of the economy broken?
Excellent question, Luis, and it's very insightful as well. And so it's a question that we try to address in a recent work of ours that is titled "Savings Glut of the Rich" for people who are interested. As you said, if you take a step back and think from the traditional lens, we always think of more savings as an excellent thing. We also think of lower interest rates as a great thing, lower cost of capital. And we have seen both of those in abundant amount, if you will.
Yes.
The cost of capital has never been as low as it is today. If you go by the risk-free rate, it's in real terms, it's negative pretty much globally as far as the advanced economies are concerned, at least. And yet, there is a remarkable fact, which is if you look at investment, which is what your question is about, investment actually has not gone up at all since 1980s. So we have this, this downward trajectory of real interest rates all the way to negative territory, number one. And number two, we also have had more and more savings in a gross sense of the word, which is, we sometimes call it as the global savings glut, but as we point out, there is an equivalent savings glut of the rich, which is to say, if you focus on the top 1% that, as I said, from the 1980s onwards have been accumulating more and more, or have been gaining more and more of the income share. As is very well known from the time of Hobson and others, these individuals, this group, this cohort, tends to save a lot more of their lifetime income relative to the rest of the population. So what ends up happening is that the overall gross savings in dollar terms, if you will, continues to rise. And that is exactly what has happened. And yet, despite this greater availability of savings at the lowest possible cost of capital that you can imagine, the remarkable fact is that investment to GDP has not gone up. In fact, it has gone down since the 1980s. And so I think that's a fascinating question. I actually don't have a full answer to that question. But taking that as an empirical fact, as given, we have a problem. That's what I'm calling the imbalance. The problem is that excess of savings relative to what the economy is willing to absorb as investment, despite all of the incentives, if you like, with very low interest rates, tells us that we need to rebalance the economy in some other way, that the saving equal to investment basically is not working out. And what is happening is that excess of savings over investment is showing up persistently as additional credit. And this is what I was referring to as in terms of this rise in total credit to GDP since 1980s, which is needed to absorb this excess saving over investment.
So at some level, we think, okay, we need to regulate banks because, if they go in trouble, either through too big to fail or through deposit insurance, we're going to be on the hook for them. But we usually don't think we need to regulate households. If there is more credit available and they want to take it, then better for them. That's if there is more ice cream, people want to buy more ice cream, well, let them buy ice cream. So however, from your account, it would seem that you're not very happy with just letting these imbalances build up, because at some point there might be a sudden stop like in 2008. Is this correct? Should we be worried about household credit? And is there something that we should be doing that we're not doing it?
Yes and no. So let me try to explain things a bit. there is a traditional framework that we have, which we refer to as the macroprudential framework, and that talks about regulation of too big to fail, regulation of household credit to make sure leverage is under control, and so on. All sensible stuff, of course, right? But those macroprudential regulations are thinking of the cyclical problem. You don't want, you're trying to avoid unnecessary fluctuations driven by excess financial leverage and things of that sort. All very reasonable stuff. So yes, we should obviously continue to think of that reasonable stuff. Nobody can argue against it. So that's the yes part of my question, if you will. But here's the no part, which is again, and that's again, I try to start the story always from 1980 because I want to bring the focus to a structural secular problem that we are facing, which the standard macroprudential tools are not going to be able to address, if you will. So let me give you one way of thinking about it. Suppose today we stepped in and we say, you know what, we are banning all credit. Let's take the extreme view. Nobody can borrow anymore because household credit. Now, what's the problem with that? I mean, obviously it's a draconian thing to do, but what's one problem with that? One problem with that from a macro view is that if the economy has, in the aggregate, insufficient demand, and you partly need people to borrow to generate demand so that we have full employment, as soon as you mandate something like that, you're going to have a macro slowdown, a recession, and so on. And so that's why we need to think at a macro level to say, okay, you can't just play with things in, as we say in technical terms, partial equilibrium and ignore the bigger picture. And which is why I keep coming back to the problem of the savings glut. Because if you continue to have that savings glut at the top of the income distribution, you can prevent people lower down the distribution from borrowing. But if the savings glut at the top persists, and as we already talked about, real investment is not absorbing that, we have a problem. We will fall into a demand deficient liquidity trap, which will lead the economy into a recession, people getting unemployed and so on. And we know it's precisely the same class of individuals that you just prevented from borrowing, they are going to bear disproportionately the brunt of higher unemployment. So we are going to be faced with twice the problems that we were trying to correct in the first place. So that's the no part, that it's not going to really address this structural issue, which really again is one of imbalances, it's one of extreme inequality, and that's where we really need to focus on in the medium to long run.
So if you think back, I mean, one thought just before I pose the question. When you read Keynes and when you think about how economists see these imbalances, a bit as you were pointing out, they have to do with cyclical issues. They have to do with, well, at some point there's maybe a supply-demand imbalance. There's people who are scared, etc. They don't want to consume. There's too much savings. But what you're talking about is completely different from what Keynes was talking about, right? Because you're not talking about at some particular point we need a counter-cyclical fiscal policy. You're talking about how over decades something is actually not adding up. Is there a precedent for this view? Who has historically this view has to do with inequality between rich people who are saving, and people who are consuming. It's a bit like Keynes, but at a particular moment in time instead of over time. So who in the cross section, who would have thought about this? What is the inspiration, or what are precedents for this kind of views?
Yeah. Well, first of all, we think, and when I say we, I should acknowledge my co-authors, Ludwig Straub at Harvard and Amr Sufi at Chicago, that we've been focusing on this question recently, and we have a few papers out, as you mentioned. Obviously, we feel that this view is not represented sufficiently, which is why you write papers to begin with, otherwise yes. you don't. So we do feel that there is a need to express this view and to make people aware of the importance of this slow-moving but very persistent forces in the background, which are actually driving everything, unlike the usual cyclical notion of crises that we have in mind. So in that sense, if you will, we are deviating from the standard Keynesian view, which is again a business cycle cyclical view.
Exactly.
Are we the first ones? No, of course. As you know, you're always standing on the shoulder of giants. And You go back to work of Hobson, for example, and many others, and they pointed out this problem with extreme inequality that results in these imbalances that need to be corrected in the economy. What we are trying to do, hopefully a bit differently, is formalizing those ideas more in the sort of the modern economic framework, if you will, and also trying to make clear or more transparent some of the implications for policies, and most importantly for monetary policy, fiscal policy, and tax policy in particular. Because I think some of the implications that result from that view, that longer term implications of inequality, are very different from the usual kind of business cycle Keynesian view of the world, shows up when we think of implications for policy. So let me just, as a small example, perhaps, let me just give you monetary policy, use monetary policy as an example. In the framework where this savings glut driven by persistent rise in inequality is driving everything in a sense, one implication for that is that the natural rate of interest continues to fall. It has to fall because it's the lower long-term interest rate is trying to equilibrate the imbalance between savings and investment that we talked about. So monetary policy, which is just controlling the short end of the interest rate, is going to be forced in the direction of lower and lower interest rates, and it's not like they have that much control over how to set long-term interest rates. They are being forced down, number one. Number two, there's another interesting insight that comes out from this, which is this notion of limited ammunition. And that is, monetary policy partly works through creation of new credit. So you lower the interest rate and you kind of give a sugar boost to the economy because you allow people to borrow, and that shows up as spending, and that might be very well be needed and so on. I'm not saying that's the wrong thing to do. However, when you do that, when you raise the level of debt for those who, in this background of rising inequality, whose incomes are not rising as fast, subsequently, the only way for these individuals to pay back what they have now owed is for interest rate to fall even lower. This is the process that we refer to as indebted demand, which is to say, okay, you can lower interest rates now and boost credit, but a consequence of that is that you will be forced to keep interest rates lower for longer going forward. And so there is this very real trade-off. Another way of thinking about this is that if you use easy monetary policy to boost demand through credit, interest rates going forward are going to be lower for longer. And so this notion of normalization back to some long-term fixed point is
never happens.
Correct.
Absolutely. So let me give you a Chicago view of what you're saying and see why it's wrong. So a Chicago view would be, okay, people are getting older, they're scared, they want to put more money away for their retirement. We see that everywhere. Demographics are consistent with what you're saying. And, the internet economy doesn't really need a lot of investment because we don't need to create factories of zeros and ones. The zeros and ones are just produced and reproduced at zero cost, at zero marginal cost. And so what we see is low interest rates because people want to save a lot, but we don't have much use for it. But if we try to counter that, in some sense, we're stopping people from taking care of their old age, etc. What's the main argument against this? The fact that this is happening differently in different parts of the distribution, is that the key thing?
Yeah, so one response to that is just purely empirical. Actually, let me take a step back. Obviously, everything you said is true in the sense that populations have been aging, number one, and number two, one of the consequences of that is exactly as you described. So I don't want to deny that that is a force that goes in the same direction in terms of pushing interest rates down. However, this force is empirically not sufficient to explain what we see around us. And there are a couple of different ways of saying this, but let me give you one example of that. You can take the US as an example. So I am trying to link inequality with more credit availability, right, for example. Mm-hmm. So one way to test for that, I'm primarily an empiricist, so I always like to put data to these theories, is to
very good one.
look within the US and look across states, something we have done in work, Savings Glut of the Rich. And the advantage of that is that you have a lot of variation across states in rise in top income inequality. So not all states in the US see the same extent of rise in top income inequality. However, demographics are roughly similar, or you can control for any differences that you observe. And the interesting thing of doing that experiment, if you will, is that states in the US that have seen a much stronger rise in top income inequality also tend to be states that have accumulated a lot more in assets, financial assets, and primarily fixed income assets, and primarily financing of government and household debt, precisely as the story I was suggesting. And then you can quantify it, and so you can say that you can show that this is actually, the magnitude is large enough to explain the time series trend that we observe. So again, the point that I'm trying to argue here is that quantitatively, when you look at this question empirically, the rise of the savings driven by the top income inequality is a very important piece of the savings glut. Again, I'm not denying the demographic shift, that's real as well, but it's not as important as the rise in inequality.
Mm-hmm. Now, one consequence of this cycle that you're highlighting is that as debt accumulates, interest rates go down, we see stock market prices soar, which in turn increases even more this inequality. Can you explain this aspect to people watching?
Yeah, that's a fascinating question. First of all, Luis, you and I are both economists, so I think we can gloat a little bit on as we think of these questions. This is why I love economics, right? Because it's precisely that, I think while people criticize us for many times the right reasons, I think I just want to, here's a plug for our field here, that the reason I love economics is that it forces us to think of the economy as a system. And everything has to add up collectively in the system. And when you force yourself to go through that thinking, it gives you insights that otherwise quick thinking would easily ignore. And one consequence of that sort of thinking is precisely what you just pointed towards, which is, look, the interest rate does not fall from the sky. The interest rate is one of the most important prices, if you will, in the economy that equilibrates to balance out whatever else is going on in the economy. And as we talked about earlier, given this rise of savings and the difficulty of saving equaling investment, interest rate has had to fall to generate more credit so we can balance the economy. And so that's the process that has been going on. While that process is needed to balance the economy from day to day, year to year, if you will, it has deeper, longer run implications, which is basically what your question is about. The deeper implication is the following. And this, by the way, always reminds me of Henry George. If people have not read Henry George, the famous political economist about 100 years ago, they should really read up on that. And the reason this reminds me of Henry George is because think of people who already own assets. And not just assets, but assets that are in inelastic supply. So think of someone owning real estate in Manhattan, that piece of rock that God created, you cannot create more of those rocks for whatever reason, or Bay Area. Anyone who owns those precious assets, as interest rate falls because of the forces of inequality, if you follow our story here, as interest rates fall, one of the natural consequences of lower interest rates is that asset prices rise. And they rise the most for exactly the most precious of assets, those who are in inelastic supply, the big Manhattan rock that you cannot easily recreate. And so what ends up happening is, this is ironic, right, that you are going into a world of lower and lower interest rates because of higher inequality. And the forces of adjustment, natural adjustment, if you will, are very unfair, actually, if you take a step back, because those forces of adjustment, which is lower interest rate, once again, are actually benefiting those who already own assets. So that sets in play a very interesting political dynamic, which is those who are left out feel even more left out as interest rates fall, because now they feel, my God, I thought I need to save for 5 years to buy an apartment in Manhattan. All of a sudden, that calculus has shifted to 15 years because the prices in Manhattan have just risen that much. And this is the same story in Barcelona, in London, and so on. And so the younger people in particular, and those who are not getting wealth passed on, feel even more and more left out. So you can see that this starts to build social and political resentment and polarization, perhaps, if you will, in the society and in the economy as well. And so, in my view, all of these things are connected. That we are not just seeing, I just focus on 3 variables, inequality, credit, and the interest rate, because I wanted to limit the conversation to economics. But if you really go towards the politics, I would argue that the same forces then connect to the economics as well. And this sense of resentment of being left out, it shows up in different ways. And many of those ways are obviously not very, very positive for our overall societal well-being. And so we need to think very differently. I think we haven't talked about, okay, what to do next, what comes out of this, but I do want to, I guess if I have a frustration, and, again, you talked about why we are writing these papers, it is because we want to convey this sense of urgency that we need to think differently. This is not our usual standard cyclical problem that we are facing. And for example, while I completely agree we need to run deficits, we need deficits, but deficits are not the answer, because the structural problem is this unbalanced economy that we have. And to address it, we will need to be bolder in what we are willing to suggest and implement.
I want to go to those solutions and also to our role in designing them. But I want to first spend some time on the current shock, the COVID shock, which I don't know if to your surprise or not, but it has even increased largely the forces that you worry about. Saving rates have increased, but they have increased in a very, very heterogeneous manner, with a lot of that saving increase being accumulated by the wealthiest segments of the population. For example, in France, 2/3 of the savings accumulated since confinement went to the 20% wealthiest people. So also government debt has significantly increased. So do you believe that the COVID shock has actually exacerbated the rich savings that you've been talking about and you describe in your current work?
Absolutely. I think one very important, in my mind, actually the most important attribute of the COVID crisis, which is of course global in nature, first of all. 2008 crisis was also global in nature, but this one is actually even more global, I believe, in nature than that. But the most important attribute of the COVID crisis, which makes it a lot more dangerous than the 2008 crisis, is the unequal experience of this crisis. It's really remarkable. If you look at the loss of earnings, for example, take the US, for the top 1 or the 10% versus the rest, you always have both those groups suffering, but they tend to kind of go, to some extent at least, go together. This time, this is like the Zoom recession. Like you and I, who can continue to do our work over Zoom, we are largely unaffected, at least relatively, I would say. But people who depend on personal contact and so on, which tends to be relatively lower earning occupations, they have been brutally decimated as a result of this crisis. So that gap of how people have been hit, it's really remarkable when you look at those graphs. This recession versus the last 3-4 recessions in comparison. And for everything that we have just talked about, but now go back, go back 30, 40 years and look at the source of our structural problems, which is this unequitable growth and this buildup of inequality. And now add to that this big crisis that has even further separated, if you will, the haves from the have-nots. So it just doubles down on the same sort of break that the economy and the society was facing. So I do feel that the urgency of addressing these issues, it was always there, but it's even more so now than before.
In a seminar you gave in April, I was taking a look recently. You present different archetypes of policies that can be considered to respond to the COVID shock, stimulating private debt to buffer the shock, government funds transfers, using public debt, government funds transfer, not using debt, but taxing progressively. What should we be thinking of doing? What would be your preferred, given how it fits in the longer run of your work? How should we be dealing with this crisis, with this shock?
As I tried to repeatedly point out, the forces are deep and structural, if you will. And so, as is often the case, the solution to those problems is never like quick and easy. It's not a vaccine that we can just inoculate and be done with. So I think it's a multi-pronged approach. But first of all, in terms of the consequences of the policy choices that we end up with, that's very clear. And so the first thing I would say is, I think it's very important to have that clarity of mind when you are designing policies, that you know the target you're wanting to hit. And the target we want to hit is to move the process of growth to something more equitable, number one. And number two, addressing some of the legacy issues of this negative process that we have seen. For that, you will again need some bolder set of policy. So let me start suggesting some. The first is, we've already talked about this fall in investment. So I think there is a much greater need for public investment than has been the case. I'm more familiar with the US statistics, so let me give an example from that. If you look at public investment as a share of GDP or as a share of overall government spending, it has fallen, more than half. It has fallen, to, I would say, like 40, even 30% of what it used to be in the 60s. So that's a very large decline in public investment. The US government spending has shifted more and more towards transfers. That's another way of saying that. And so the composition of government spending is something that needs to be really addressed. While transfers are important, of course, they should not come at the expense of public investment. So I think there's an obvious thing here to do, which is to boost public investment. And if you have to run deficits to do that, that's fine. That's okay. But public investment, and then the nature of that public investment has to be such that the gains from that public investment disproportionately go towards the bottom 90%. And it's a whole sort of different conversation of how to design that and so on. And I know it's easier said than done, but that is a direction overall in which we need to go. More public investment, and done in a way that the returns are going towards the bottom 90% disproportionately. The second aspect of that has to be redistributive in two ways, in my view. The first one is that if you need to add up the direct and indirect taxes, for example, again, talking about the US, which I know more about. And when you add up direct and indirect taxes, the US tax incidence is just not progressive enough, basically, especially given these problems. And so I think there is a need to actually lower the tax burden for the bottom 90% of the population. Again, I'm counting indirect, like payroll taxes and so on. So, obviously it's the collective that matters. And so we need tax reform on that side. Now and then obviously some of those taxes have to be put on at the very top, at the top 1%. But let me say one other thing on this issue of tax reform, again, from the perspective of balancing the macroeconomy. Notice I'm not making any net revenue statement here, very deliberately so, because I think the problem is not, that's an important question. So I don't want to say again, like the demographic question, that's not important. But I think there's a deeper issue here, which is we need to rebalance the macroeconomy, again, bringing the savings equal to investment and preventing the excess savings from that perspective. And so we need to think of fiscal policy as addressing that problem as well, and not just a total revenue problem. And that's why I'm actually okay with lowering the interest rate, the income tax rate for the bottom 90% of the population. We need to add progressivity at the top 1% in particular, and we need to seriously think about adding an Elizabeth Warren style wealth tax at the top 1%, because that works in exactly the right way in addressing these imbalances that we are talking about, especially in light of the legacy that we talked about. This fall in long-term interest rates has boosted wealth levels, not because of any sort of sweat and toil of those individuals, but because they have just enjoyed falling interest rates because they already had assets. So I think we need to think seriously about wealth taxes, again, in the Elizabeth Warren, I would say, ballgame. And the last thing is promoting competition. I mean, it's, again, a lot of people have talked about this, this work very well, Luis. The rise in concentration, the rise of big monopolies, that is a very good candidate for restricting investment, something that we talked about earlier as well. And so that also needs to be addressed. So I think it's a combination of these three, public investment, redistributive taxation along the lines, and then making it a more level playing field, promoting competition. I would say those three are the main ingredients we need to push on. There are, of course, many others, and other people have more expertise on that, but from my vantage point, those are three pieces that I see as being very important.
Very, very interesting. Let me just spend the last couple of minutes chatting with you, moving from what should be done to what should we be doing to do it. So you had a very kind of well-known episode where you actually were willing to kind of go into actually policy making in your home country that actually didn't pan out. What do you think about the role of economists in trying to not just think, but also try to get things done? And what do you think of your own personal experience in that respect in Pakistan?
Yeah, as I mentioned earlier, Luis, I feel very passionate about economics as a field, and I think there's a lot. There's a role that we can play that is very different and unique. And again, as I mentioned earlier, it is the reason I feel that way is because economics as a discipline forces you to think about the economic system as a whole. It forces us to think about how we are all actually connected together. And there is a sense of thinking about the collective over and above just the individual. We have different names for that, externalities and things of that sort. But those are just technicalities. I think at a philosophical level, there is a very deep insight in economics, which is that the sum should be bigger than the parts. I mean, that's the definition of a good economic system, where the sum is bigger than the parts. And because I feel very, very, very passionate, as I said, about that value of economics, I view myself as an insignificant cog in that wheel. I see myself as, potentially being of help in answering some of those bigger questions for the society. And so perhaps if I were to give an analogy, I would say, just like a physician, if you think you can treat someone, it's your duty and obligation. So yes, I'm from Pakistan, but regardless of which country actually asked me if I could be of help, if I think I can be of help, I would jump on it, whether it's Pakistan or whether it's Bangladesh or whether it's South Africa or whatever. So first of all, that's my personal view. And obviously I am from Pakistan, so I do feel a little bit more passionate about Pakistan. Let's be honest, it's my first home, and then the US became my second home. So I said yes, but unfortunately, the reality is that there are always forces of extremism in different countries, and Pakistan unfortunately has been subjected very viciously by these forces in the past. And those forces of extremism did not view my participation as a good thing for the country, and they actively but they did come on the streets to prevent me from taking part in decision making. And the government, after weighing the pros and cons of whatever political trade-offs they need to weigh, they decided to let me go. And so obviously I'm not going to force the issue. So I'm here talking to you, Luis, which is not that bad, actually. I enjoy that a lot as well. So
I enjoy it very much. I am sorry for Pakistan. That's their loss and our gain. Thanks very much for all your thoughts. I thought it was a really fascinating conversation, and I really look forward to continuing reading your work, which I think is among the most insightful that any economist is doing right now. So thanks very, very much.
Thanks, Luis. It was a pleasure talking to you.
Okay.
Thanks.